Welcome to Accounting Life with Jotham Ty. Our guest today is Michelle Valentine, co-founder and CEO at Anrok. In this episode, Michelle breaks down sales tax complexities, economic nexus, and compliance challenges for software and digital businesses. From remote employees to international VAT, Michelle shares key insights for finance professionals. Now, our host, Jotham Ty.
Hey, Michelle, welcome for the very first time to our Accounting Life podcast. Thanks for joining us today.
Excited to tackle these questions.
Questions will be coming, Michelle, because a lot of our audience are corporate accountants like me, so we do debits and credits. A lot of times we look at like a sales tax payable, and whether it's a recon or a journal entry, and frankly, a lot of us accountants don't know much about sales tax, so you're the perfect person to have on today's episode, and hopefully you can enlighten us with your wisdom on sales tax. I know there's a lot going on there, so I'm just going to start and fire away if you don't mind. I think the very first place that we should start with this conversation is, how does sales tax different from other taxes, right? Because us in accounting, it's tax all day, whether it's income tax, corporate tax, indirect tax, tax provision, and sales tax is obviously an important piece to all of that. So how would you describe sales tax in your own words? And how does that differ from the different types of taxes out there?
The Crib Notes version, whether you're a controller, finance, not a tax expert, I'll keep it simple. Sales tax is paid by the consumer and remitted by the merchant to the states. So if you were like me and bought a cup of tea or a cup of coffee this morning, you as the consumer paid the sales tax that then got remitted by the merchant to the government. Other common types of taxes, let's take income tax as an example, is paid by the business on its corporate profits. So that's revenue minus expenses. And the key thing here, and I think the implication that a lot of technology companies often miss, is that with income tax, you're operating at a loss most of the time. Even big companies, as they prepare to go public, might only just be starting to make a profit or be on the path to profitability. With income tax, you don't have a profit. And so you can save those losses to offset future profits. There's no cash implication with income tax. Whereas with sales tax, it doesn't matter if you're making a loss or not. You need to think about sales tax. You're accruing liabilities upon invoicing the customer. So that's a key difference between the two for anyone touching finance and cash.
That's a huge distinction. And actually, my EVP of revenue pinged me because he saw something on the news today about Nevada being a new place for corporations to set up an entity because of the income tax savings. But he asked whether we should do it. And for companies like us that are earlier stage, we have net operating losses, right? Because from a tax income perspective, that's not something we have to worry about on the corporate side for a while. But when it comes to sales tax, it's different, right? As you're selling to your customers, there's a tax that's already being incurred there. And I think that's a good way of actually distinguishing the difference between the two. So yeah, super helpful. I also wanted to, oh yeah, go ahead.
And something that finance often asks me is, hey, can I ask my customer to pay sales tax later? I don't want to handle that right now. Can I just go ask my customers later to pay the sales tax when I get audited by the states? That's a really bad customer experience. And so the way to think about sales tax is it happens upon invoice. You accrue those liabilities. So even if you don't do the action, collect the sales tax from the customer, you're accruing liability there. And so for folks that want to do cash accounting for sales tax, that's actually not the tax textbook way to handle it. It actually happens upon invoice. And so that's something to keep in mind as folks think about sales tax.
Well, I can testify to that. And I think I may have shared this with you when we first met a few years ago. I will not name the company, but I was once a consultant for a company that was about to go public and had not paid their sales taxes since inception. So it was going through an audit. We went through a VDA process, and it is painful. So yeah, I think just the awareness that this is like something that needs to be addressed now. And it sounds like you probably work with companies that are just thinking about it or may not have done it. I mean, I think it's an important thing to keep in mind as a finance leader, that this is an important part of um, your obligations as running a business.
And you don't need to be a tax person to keep a look out for that, right? You can be in finance to say, hey, are we accruing these liabilities correctly? And that could be a huge cash implication, and you can really save the business by pointing it out.
Exactly. Would like to drill down because a lot of our audience members are actually in the tech industry, and it's just very natural. We're the accrual platform. We're first to market with our accrual management platform. So a lot of the customers that we have are early innovators in the tech industry. A lot of them are in software. So a lot of our listeners are probably in the software industry itself. What makes compliance uniquely different for software and digital first companies in particular?
Number one is your customers are everywhere from day one. So if you think about traditional retail-based purchases, you have a physical location, and that's what sales tax rules were built around. And so if you have a shop or an office or a warehouse, that creates what's called nexus with the state. So you have an obligation to collect sales tax. And then the tax rate itself is based on where the customer purchases the good. So in a physical world, those two things are the same place. The shop, where the business is, and then also where the customer is purchasing the good. For software and digital companies, what gets tricky is that those are often two very separate locations. So one, the first question is, do you as a business have a physical presence? And then now there's something called economic nexus in a state. And we can go into the economic piece later, but to keep it simple, do you have a presence and obligation to collect sales tax in the state? Yes. But your customer could be anywhere within that state where that transaction is happening. And so the actual tax rate, the state rate, the county rate, the city rate, sometimes there's a special purpose district rate, is based on their rooftop address. So that's the biggest tricky thing for a software company, where their customers are everywhere from day one. And so remember, you want to collect their addresses to help make sales tax calculations more accurate. So that's number one. Customers are everywhere. Number two is a lot of the edge cases around tax rules impact the digital economy the most. Reason being is non-tangible goods like software tend to be the most controversial. So let's say if you're taxing the shirt, for example, the state, the city, yes, it's a t-shirt, a button-up shirt, we tax that. That's not controversial. But if it's intangible software, the state and city might have different opinions. In almost all cases, the cities have to follow the taxability set by the state. But of course, there are exceptions, right? In tax, it depends. And so there are some cities like Chicago, for example, that can say, hey, we're taxing software, but the state does not. And so those discrepancies in those edge cases are the things that software companies need to keep an eye out for. So these are called home rule cities. There are a little over 70 of them in the state of Colorado, for example. Alaska doesn't tax software at the state level, but some local municipalities do have a sales tax regime. So a lot of those edge cases impact software digital goods the most, because that's where the discrepancies are. And then maybe the last one, just quickly, is usage-based pricing. You have subscriptions, you might prorate down to the second or minute that a customer purchases your software. And so your invoices actually change a lot. And so with sales tax, making sure that everything is staying in sync can be tricky for businesses.
That's a lot of complexities there to deal with, Michelle. And it's no wonder that we have great solutions like yours to help sort that out. And I know we have customers that use your product today, and it's so important. Like you were mentioning examples of how tax rules can be, the way you sell software and where it's being sold can be different for so many different reasons, whether it's a city or a state, and there's just so many different things to track. You mentioned nexus. I mean, nexus is a word that we in the corporate accounting world have heard a lot about, but we know that word in itself sounds already complicated. And Yeah, it sounds like there's just a lot going on, and there is something too that we're hearing impacts like tax compliance, and it is the remote workforce. The remote workforce itself sounds like makes even more fun. This process a little more fun, right?
The complexity is precisely one of the reasons why I felt passionately to start Anrok. On the one hand, I understand why governments need sales tax regimes. It funds a lot of important local services like schools, fire departments, water utilities. But on the other hand, the burden is huge for businesses, especially the digital economy. And so the former venture capitalist in me who likes backing the underdog felt some outrage of, hey, there must be a simpler way to do this. You don't start a business to think about this compliance complexity. And so the goal at Anrok is to really make it easy for businesses to track where they have nexus. And so your question was around physical nexus, remote employees. That is a huge thing that happened, especially in the last few years with the pandemic, where almost all software companies went remote and have some kind of hybrid remote implications from that period. And so the interesting thing there that people often miss is they say, hey, I don't have an office, so I don't really have a physical presence. But the question is, do you have a remote employee? If you have a single remote employee in a state, you have physical nexus in that state. So that's something that a lot of companies didn't realize when they went remote. And another reason why finance needs to be working very closely with the talent teams on the hiring strategy, making sure that's in step with your tax and finance teams to say, hey, are we actually going to register in all of these different states? Do we have the capacity to even manage compliance and do returns in all of these different states?
My guess is that a good number of companies during the pandemic probably did not take these considerations in mind. And that's natural, right? Like us as businesses, we're mandated to grow the business in different ways that we think is most effective for the business. And during that time, it was leveraging remote employees in different states. But in doing so, there are responsibilities that we in finance have, which is making sure that we stay in compliance.
And in some ways, this physical nexus or remote employee issue is a little bit more of a smaller business problem because there's the second layer of nexus, which is called economic nexus, where if you're a large company and making sales everywhere, you might already have nexus everywhere. So maybe I can break down what economic nexus is and why that might mean if you're a big business, you already have obligations in all of these different states. So maybe the hiring strategy doesn't need to be as closely tied to like the finance strategy. So economic nexus was introduced in 2018 through a Supreme Court case called South Dakota versus Wayfair. So Wayfair is that furniture online business. And essentially it was the government's waking up to the fact that a lot of the economy is now online. And you might never have a physical presence in a state. You might never have an office or warehouse, but you're making millions of dollars in that state. And so government said, hey, you have nexus, a close enough relationship with me as a state, if you pass this revenue or transaction threshold. And a very typical threshold in the state of Washington, for example, is $100,000 worth in revenue, for example. Typical transaction thresholds are something like 200 invoices, which if you're a SaaS business and you're invoicing monthly, you hit up against that very, very quickly. And so this created an ongoing monitoring problem for software companies where you have to watch your sales in all of these different states, which have all of these different thresholds. They have their own thresholds. And figuring out, okay, if I've crossed this threshold, I now have to register and collect and remit sales tax on every sale in those states going forward. So that's economic nexus.
Yeah, economic nexus is definitely a newer expression for me. And again, very helpful for our audience here because I think these concepts, they're just not something we learn in our day-to-day jobs. So yeah, I'm glad you elaborated on that for us. You did mention, the difference between big companies and, how maybe fast-growing, up-and-coming SMBs, maybe looking at compliance in different lenses. I do want to switch gears and focus maybe on the bigger companies who have international operations. I know here at Gapify, most of our companies are publicly traded, have international operations. So do countries outside of the U.S. tax software, and what does that look like?
Over 100 countries worldwide tax digital goods and software. It's pretty wild. And it is often in the form of something called VAT, value added tax. Sometimes it's GST. These are all different forms of indirect tax. And as a finance person, you don't need to understand the details of, hey, VAT is you're adding tax bit by bit along the chain. The simple thing to remember is if you're selling to B2B in many VAT countries, so Europe is mostly a VAT jurisdiction, you want to be collecting something called a VAT ID from your customers there. If you're doing B2C transactions, the thing to remember is in a lot of these countries, it happens on the first sale. So differently to the US, which we just covered, where there's this concept called nexus and you hit it based on these different thresholds, with many VAT countries, it happens on the very first sale.
And actually, that reminds me of a process that we're familiar with on the accounting and controllership side. When we're onboarding new vendors in our ERP system, like we have to designate which ones have these like certificates and different like designations, right? Because it probably impacts things that are happening on the accounting side. And I know your platform automates a lot of that. So you definitely want to ask you about that in a minute. But before that, so in the unlikely, hopefully, event that a company goes through a sales tax audit, like what would an accountant or someone involved in the process, what should they know?
So ideally, you have a modern tax platform in place where you have full visibility across your sales worldwide. And so what you should be able to see with your tax platform, even if you're not remitting or registered in the countries yet, you should be able to at least see it and know, hey, I took this, risk-weighted approach in this country because the exposure is small, we don't have the resources, but I'm aware of it. That's like the ideal situation to have something where you have visibility and you get audited and and can inform internal stakeholders immediately what you're looking at. Zooming out, audits on the sales tax side can be triggered for various reasons. And given it's such a jurisdiction by jurisdiction problem, it's not uncommon to be audited. So, the state of Texas could be auditing you and New York and Denmark, for example, in any given year. It's very, very normal. So first step, don't worry, it's a normal course of business. And their primary focus is to figure out, have you under-collected, under-reported the taxes that you've sold, and also understanding what your exemption situation is. And so when you receive a notification of an audit, the first thing to do is to respond and say, hey, acknowledged, and notify the key stakeholders in place. The second part of this is if you're using an outside accounting firm to help you understand your liabilities, it doesn't hurt to then bring in a modern tax platform if you don't have it already, to actually do a second check, trust but verify. And in cases where you're catching up to liabilities, the data is often messy. And this is where technology can really help and clean the data for you, present it in a way so you can actually gut check, okay, are we looking at $1 million liability? Are we looking at, a 100K liability, or is this a $10 million liability? And just really size up historically, what are you looking at?
Really helpful. And, of course, I'm a little bit biased here because we also are a technology platform, but your point there about just leveraging tools to help like organize data and actually, have data to support different numbers. I mean, that itself drives a lot of value. And it's the same with our customers. They'll ask us to automate the flow of getting POs from one system and helping them automate their accrual calculations because of it. A lot of times the PO data is stale or incorrect, but until you run it through a platform, you don't really know. So we're kind of supporting the process of cleansing data, and it sounds like that's an important piece to a potential sales tax audit. It sounds like also, gosh, this is something I didn't realize. So you could probably get like an audit notice from any jurisdiction at any point in time, right? So it's not like they all come in as like one batch. Like the city of Chicago can send you a notice today, and the state of New York can send you something a couple months later. Is that how it typically works? There's no like cadence to it?
There's no method to the madness, as it were, but there are one or two things that I've observed that might increase the chance of an audit. And in the US in particular, if you hire someone in a state, you're much more likely to have an audit, given that the different state departments talk to each other. And so they might notice, hey, like they're paying payroll tax. Are they paying sales tax? So that's one thing to keep an eye out for. But really, there isn't a way to anticipate these notices.
Quick note out to our friends in the controllership. We only have to go through audits once a year. It's scheduled, it's timed. So I think that visibility for us is comforting, as much as we hate going through that process each year. But in this case, wow, there's just so many details. And again, like I think this is why automation and technology is important. So Michelle, as we wrap up here, just wanted to maybe wrap up with tips on like how to go about evaluating and implementing sales tax automation solutions like an Anrok.
I would start with implementation time. Your time is money, and the good news with sales tax tools is that it should not take as long as an ERP implementation. It should not be 9 months long. It should be 1 or 2 days, maybe 3 weeks if you have a very complex system. So customers on Anrok that might have a homegrown billing system where there's some like custom code. They might have multiple billing and payment systems to integrate. They might have worldwide transactions, high volume. That super complex example has taken 3 weeks in the past. So number one, when you purchase a sales tax solution, really understand the implementation time, because time truly is money when it comes to sales tax. Number two is user experience. And specifically in that is this real-time exposure visibility. So can you see worldwide transactions in your platform? Do you get notified in real time when you've crossed nexus in a jurisdiction? And specifically, do they compare it with your product taxability? What good is a notice if they send you a notification over email says, hey, like you've hit nexus in California, but California doesn't tax software. So that notification is useless. What do? It's just created work for you. So user experience, real-time notifications really matter. Last thing, is it enterprise grade? You're a big company, you're audited by the Big Four. Has this gone through a Big Four audit before? So really thinking about not just like the cost of the sales tax platform on its own, but comparing it to the cost of having to go through audits and that time spent, and also maybe missed tax calculations. That's where the real cost is. So those 3 things: implementation time, user experience, and enterprise grade. Those are the 3 things I'd think about.
That last part there definitely resonates too. And there's obviously you can't quantify the cost of audit overruns from certain issues that come up, but when that does happen, it is not pretty usually. So I know some of our customers have thought about that in procuring Gapify too, and it sounds like same consideration for Anrok. Michelle, this is a really good starting point for our audience to get exposed to sales tax. I would love to have you back on for another episode and maybe talk more about AI and some of these other fun things. But I think for those of us, especially in the controllership, that are newer to sales tax, this is such a great level to start with. So I appreciate you taking the time to join us today.
Thanks.
Thanks again, Michelle, and we'll talk soon.
Thanks for stopping by. We hope you've enjoyed this episode. If you want more information, please check us out at gapify.com, and we'll see you next time. Bye, everyone.